Welcome to Tech Money Madness Weekend Edition, your bite-sized investor education series. Today's topic, value versus growth investing. Two schools, one goal.
Oh, it's going to be a fun one today.
It really is. So I want you to imagine walking into a dingy, dusty thrift store. You're digging through these racks of clothes that everyone else is just completely ignoring.
Right, the stuff nobody wants.
Yeah, exactly. But suddenly you spot it. A pristine, high-quality designer winter coat.
Oh, nice.
Yeah. And the price tag says $20. So you check the stitching, you recognize the brand, and you know for an absolute fact this coat is easily worth $200.
So you buy it immediately?
You buy it immediately. Now, I want you to imagine a completely different scenario. You are walking down the street in this really cutting-edge neighborhood, and you spot someone wearing a radically new style of jacket.
Okay.
It's strange, it's expensive, and literally nobody else is wearing it yet.
Mm-hmm.
But you look at it and you realize that by next winter, every single person on the planet is going to want that exact jacket.
So you buy one now?
Right. You pay a premium for it simply because you know the demand is going to absolutely skyrocket.
Yeah.
And, well, that right there is the billion-dollar difference between value and growth investing.
I mean, that really is the perfect way to visualize it. We are looking at two completely different lenses for viewing the exact same market.
Yeah.
We're basically breaking down two dominant, often hotly debated philosophies that both want to get you to the exact same destination.
Which is building long-term wealth.
Right, building long-term wealth, but their maps for getting there have almost nothing in common.
They're totally different.
Oh, completely.
Mm-hmm.
So, based on the Investopedia definitions, value investors are hunting for those hidden thrift store bargains based on a company's current intrinsic worth.
Right.
But growth investors are scanning the horizon. They're looking for companies expected to experience just high growth rates in the future. They want an explosion of revenue or market share tomorrow, regardless of whether the stock looks cheap today.
And our mission today is to clear the noise so you, listening right now, can figure out which path actually makes sense for your own portfolio.
Because it can get super confusing.
It really can. When you open up a financial news site, it feels like everyone is just yelling a different strategy at you. It is incredibly easy to get caught up in the hype of a single stock without realizing you might be mixing up two fundamentally different rule books.
And blurring those lines is exactly where a lot of portfolios get into trouble.
Yeah.
To truly understand which rule book you should be using, we kind of have to look at where these philosophies actually came from. I mean, they weren't just invented in a vacuum by someone sitting at a modern trading desk.
No, not at all. It's easy to think of them as just, buttons you click on a brokerage app. But value investing was essentially born as a trauma response.
That's a great way to put it.
Right. If we look at the origins, Benjamin Graham and Yvette Dodd formalized this concept in their seminal book, Security Analysis. And that was published in 1934.
1934.
Yeah, right in the brutal aftermath of the Great Depression.
The historical context there is everything. Graham and Dodd were writing when the stock market had it had decimated an entire generation of wealth.
People were terrified.
Terrified. People felt that investing was nothing more than reckless speculation. It literally just felt like gambling.
Yeah.
So Graham and Dodd looked at the absolute rubble of the financial system and decided to introduce this highly disciplined, completely math-based approach.
They wanted hard numbers.
Exactly. They wanted to find companies that were trading for significantly less than their actual liquidated value. They were trying to strip the emotion, the hype, and the guesswork out of the market entirely.
They were trying to create a mathematical safety net.
Precisely.
Yeah.
And in the investing world, and specifically according to the CFA Institute, this concept is known as creating a margin of safety.
A margin of safety.
Right. By buying a security at a massive discount to its intrinsic value, you give yourself a built-in cushion.
Because you bought it on clearance.
Yeah.
If the brighter market takes a dive, or if the company hits some unexpected speed bump, your downside is protected. The price can really only drop so much further before it hits the bedrock of the company's actual hard assets.
And that cushion is exactly why this philosophy, which, was famously popularized later by Warren Buffett, is so heavily favored during times of market volatility.
Right.
It's an inherently defensive posture. You are protecting your downside first and foremost.
Okay, so that's value. But growth investing comes from a completely different psychological place, right?
Oh, absolutely.
Let's pivot to the trend spotters. The growth school of thought really came into its own much later in the 20th century. It was heavily championed by legendary fund managers like Peter Lynch.
Yeah. Lynch and other growth advocates basically shifted the focus away from asset protection and toward massive, untapped potential.
Right.
They proved that by looking for companies with the ability to completely disrupt a market or scale globally, you could generate astronomical returns.
Even if the company isn't cheap.
Exactly, even if those companies weren't strictly cheap on a traditional balance sheet.
But wait, I have to push back here.
Go for it.
If value investing provides this brilliant mathematical safety net, why does anyone bother with growth?
Wow.
I mean, let's be honest, buying a company that isn't objectively cheap and just hoping it grows into its own massive hype, it sounds inherently reckless by comparison. Why walk the tightrope without a net?
I get that. It definitely sounds reckless if you assume growth investors are just throwing money at trendy ideas and crossing their fingers.
Right.
But true growth investing is deeply analytical. It just demands a different kind of rigorous homework.
How so?
Well, to mitigate the higher risks of paying a premium for future expectations, the CFA Institute stresses that you have to develop a deep, exhaustive understanding of a company. You need to know its financials, its management team, and the broader industry trends.
So you aren't just guessing.
No, not at all. You are making highly educated projections based on hard data to spot that exponential potential long before the rest of the market prices it in.
Right. Okay, that distinction makes a lot of sense. You aren't avoiding the math, you're just doing a different kind of math.
Exactly.
So let's actually lift the hood on that data. I want to look at how a practitioner practically executes these strategies.
Yeah.
How do you mathematically prove that the $20 thrift store coat is actually worth $200?
Okay, let's get into it. So the absolute foundational tool for a value investor is called the discounted cash flow model.
The DCF model.
The DCF model,
Okay.
right. The core driving principle behind this tool is that a company is ultimately worth the total amount of cash it is going to generate in the future, period.
Okay, makes sense.
But you have to account for a pretty harsh reality. $1 you receive 5 years from now is worth significantly less than $1 you hold in your hand today.
Right, because of inflation and opportunity costs.
Yep.
If I have $1 today, I can go invest it in a guaranteed government bond and earn interest on it immediately. By waiting 5 years for a company to give me that dollar, I'm losing out on half a decade of earning power.
That is the exact mechanism. So the DCF model forces you to discount those future cash flows back to their present value.
Okay.
Instead of getting lost in a textbook recitation of decimal points, let's look at the broad strokes of how this works. Let's say you spend weeks analyzing a company, and you project it will generate a very steady $100 million in cash every single year for the next 5 years.
Okay, $100 million a year.
Yeah.
And we're using what, like a 10% discount rate as an example?
Yeah, let's use a 10% discount rate. So for year one, that $100 million is actually worth roughly $90.91 million to us today.
Factoring in that opportunity cost.
Exactly. Then in year two, it drops to $82.64 million.
Okay.
Year three, it's down to $75.13 million.
It's shrinking pretty fast.
It really does. Year four is $68.30 million.
Uh-huh.
And by the time we get out to year five, inflation and lost opportunity have eaten away at it so aggressively that the final $100 million is only worth about $62.09 million in today's terms.
Wow. Okay, so that $100 million in year 5 really decayed.
It did. And then you add all of those discounted years together.
Yeah.
You tally up the decaying value of that cash, and you get the total present value of the company's future earnings.
Which would be what in this case?
Let's say in this scenario, that totals up to roughly $379 million.
Okay.
That number is your calculated intrinsic value. That is what the company is actually worth today.
So I have my intrinsic value, $379 million.
Right.
Then I open up my brokerage account and I look at the company's current market capitalization, which is, the total price tag the market is slapping on the entire business right this second.
Yep.
If the market is only asking $300 million for it, the intrinsic value I calculated is significantly higher than the market price.
Yes.
That's the $20 coat.
Yeah.
We just found a margin of safety of $79 million.
You have mathematically justified the purchase. You found the bargain. But, and this is a big but, as any seasoned investor will tell you, the model is only ever as good as the inputs you feed it.
Which brings up a massive glaring red flag with this entire philosophy.
Oh, yeah.
We're essentially predicting the future with a spreadsheet. It's like having a lemon tree in the backyard and guessing exactly how many lemons it's going to produce every single year for half a decade.
It is a lot of projecting.
Right. We're projecting $100 million a year. But what if there's a massive drought in year 3? What if a competitor invents a radically better lemon? How does a math formula handle the actual chaos of the real world?
Well, the drought factor is the fundamental limitation of the DCF model. You cannot predict black swan events or pandemics or sudden shifts in consumer behavior.
You just can't.
So, to handle the unknown, value investors adjust the discount rate itself. Think of the discount rate as your buffer against chaos. Yeah. If you are analyzing a highly stable utility company where the cash flows are essentially guaranteed by government contracts, your discount rate might be quite low. You trust the prediction.
But if I'm looking at a company with a ton of variables, a chaotic supply chain, and a high risk of drought, I crank up that discount rate.
Exactly.
And by doing that, I aggressively shrink the present value of their future cash, which means the market price has to be incredibly, almost unbelievably low to convince me to buy.
Precisely. The math forces you to demand a massive margin of safety for a risky prediction. It keeps you honest.
That perfectly explains the defensive mechanics of value. So let's flip the coin. What are the mechanics of growth?
Okay, let's go there.
Because if they are relying on a DCF model to demand a massive margin of safety, how do they objectively spot high growth without just throwing darts at a board?
So growth investors are fundamentally looking for exponential scaling. They want companies whose future cash flows won't just be a steady 100 million a year, but will double, then quadruple, then take over the globe.
Right.
If we follow Peter Lynch's criteria, a successful growth investor looks way past the current spreadsheet and evaluates the deep architecture of the business.
Like what?
Well, first, you need a profound competitive advantage. Does this company have a wide moat around its business that competitors simply cannot cross?
And moat could be anything, right? From
Yeah.
exclusive patents to incredibly high switching costs.
Yeah, exactly.
Like if it takes a year and millions of dollars for a customer to switch away from your software to a competitor, that's a massive moat.
It creates a captive audience for that future growth.
Right.
Second, Lynch heavily emphasized the need for a hyper-talented management team.
Which makes sense. I imagine leadership matters exponentially more for a growth company than a value company.
Oh, 100%.
Because if you buy a heavily discounted, boring utility company, a mediocre management team might still keep the lights on and deliver your steady return simply because the assets are so cheap to begin with. But hyperscaling a brand new business across the globe without breaking the supply chain or running out of cash, that requires flawless execution.
That is a really critical distinction. A value company's cheap assets protect you. A growth company's management team propels you.
Well said.
If the leadership makes a major strategic error during a rapid expansion phase, the entire growth thesis shatters.
Right.
And then the third essential element Lynch looked for is a rapidly growing market.
Right, because it really doesn't matter how revolutionary your product is if the total addressable market is shrinking.
Exactly.
You could invent the world's greatest DVD player right now, but if nobody's buying DVDs anymore, you can't scale.
Yeah.
You need a massive expanding ocean to swim in.
Yeah. A value investor might happily buy a company making a niche product in a declining industry just so long as the price is cheap enough to guarantee a return on the remaining cash flows.
Yeah.
But a growth investor absolutely requires an expanding frontier. They are willingly paying a premium today for the lion's share of tomorrow's market.
Okay, so we've mapped out the ideal scenarios. The math works, the management teams are brilliant, the markets are expanding.
In a perfect world.
Right, in a perfect world. But let's talk about what happens when these theories fail in the real world.
Yeah.
Because they do. Investors try to execute these strategies and step on landmines all the time.
Oh, all the time.
What are the common pitfalls?
Well, both philosophies have deeply dangerous, very specific traps. Let's start with the value side. The ultimate nightmare for a bargain hunter is something called the value trap.
A value trap.
It is a company that appears incredibly undervalued on paper. Your DCF model is screaming that it is a once-in-a-lifetime bargain.
Okay.
But in reality, the market price isn't actually a discount at all. It is a perfectly accurate reflection of a dying business.
Oh, so it's the Blockbuster video scenario.
That is the perfect example.
Think about looking at Blockbuster's financials right as Netflix was launching its streaming service. The stock price was likely tanking, so the math probably looked like a screaming deal to a pure value investor.
Oh, right. The numbers looked amazing.
The DCF model told you their historic cash flow was huge. But the math couldn't see that the entire business model was becoming fundamentally obsolete. It wasn't a bargain, it was a trap.
Exactly. And the CFA Institute continually warns investors about this exact phenomenon.
How do you avoid it?
Avoiding a value trap requires you to look completely past the pure numbers to identify structural, qualitative red flags.
Okay.
You have to actively watch for chronic mismanagement or dangerously high debt levels that the dwindling cash flow can no longer service, or, as you pointed out, irreversible industry declines.
Right. Good math will never, ever save you from an obsolete product.
Never. The spreadsheet lies and the world changes.
That is a great way to put it.
Yeah.
Okay, so that's the landmine for value. Where do the trend spotters get burned? What is the equivalent trap for a growth investor?
So the growth pitfall is essentially the danger of the hype cycle.
The hype cycle.
Yeah. Investopedia highlights a crucial, very common misconception. Investors easily confuse a company's exciting growth potential with its actual financial reality.
Ah,
The narrative is just so thrilling. A company announces they're going to revolutionize artificial intelligence or disrupt global logistics, and the press releases are incredible.
and you fall in love with the story.
You really do.
You want to be part of the revolution, so you buy in based on the narrative, completely ignoring the fact that the company is burning through cash at an alarming rate and has zero clear path to actual profitability.
Yes. You buy the hype, and in doing so, you overpay for the shares.
Right.
You pay a price that essentially requires the company to execute perfectly without a single mistake for the next decade, just for you to break even on your initial investment.
Wow. And when the market inevitably realizes that the hype will not translate into actual sustained revenue, what happens?
The corrections are violent
Violent.
because, unlike value investing, there is no fundamental asset floor. There is no margin of safety to catch the fall. The stock price doesn't just dip, it plummets, and that drop can completely wipe out portfolios.
It's a very long way down without a safety net.
It sure is.
Well, let's pull all this together for the listener sitting at home looking at their own brokerage account. Let's distill everything we've talked about into actionable takeaways.
Let's do it.
Value investing is your defensive play. You are actively hunting for discounts to a company's intrinsic value, and you are using rigorous tools like the discounted cash flow model to mathematically mandate a margin of safety. You are buying the bedrock.
And growth investing is your offensive play. You are shifting your focus to the horizon. You are looking for high-potential companies with massive competitive moats and stellar management teams that can deliver exponential returns.
Yeah.
And you accept that the lack of a safety net naturally brings significantly higher risks.
But the absolute most important takeaway, the underlying commonality between both these schools of thought, is that neither strategy is a shortcut around doing the hard work.
No.
You cannot just throw darts at a board and hope for the best.
Exactly. Both philosophies require intense, exhaustive analysis. Whether you are hunting for a bargain or a trend, you have to read financial statements. You have to evaluate the leadership teams. You have to deeply understand the macroeconomic industry trends.
If you are listening to this and you want to take the next step, if you want to learn how to actually do that hard work, there are incredible resources to build your foundation.
Absolutely.
If the defensive value approach resonates with you, Benjamin Graham and David Dodd's 1934 classic, Security Analysis, is practically mandatory reading. It is dense, it is historical, but it is the foundational text of the entire movement.
And if you lean towards the offensive growth approach, studying Peter Lynch's methodologies will give you an incredible framework.
Definitely.
He teaches you how to look at companies in your everyday life and spot that exponential potential before Wall Street does. Plus, the resources from the CFA Institute and Investopedia that we leaned on today are just fantastic places to continue your ongoing financial education.
We've talked deeply about the math, the history, and the mechanics today. But a huge, often overlooked part of investing is actually psychology.
Oh, for sure.
It is knowing yourself. So I want to leave you with a final thought to mull over. Take a hard look at your own personality and your own natural risk tolerance.
That's good.
When you face the unknown in any area of your life, your career, your relationships, your hobbies, are you naturally a bargain hunter seeking a margin of safety? Or are you a trendsetter, willing to take a leap without a net on the next big thing? Understanding who you are outside the market might just be the ultimate key to choosing the right strategy inside the market.
I couldn't agree more.
That's all for this weekend's Deep Dive. Come back tomorrow for more investor education and weekdays for daily market coverage. Like, subscribe, and we'll see you next time on Tech Money Madness.